Last time I considered how chasing price is something that many novice traders do, and the reason is that there's an inbuilt propensity to follow the crowd. In evolutionary terms, this has served us well and allowed us to survive as a species. However, when it comes to trading, following the crowd and chasing price will usually result in losing money. So what characteristics of price action do we need to take advantage of in order to produce a profitable trading strategy? Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. As a trader myself, I'm aware of just how many different trading concepts and strategy premises there are that are designed to extract money from the financial markets. But in this series, I'm going to focus on just 3 of the most basic ones. They also happen to be 3 of the most popular, and for good reason. These 3 categories of strategy have served me very well over the years and form the basic foundations for the majority of my own trading strategies that I currently trade. Today, I focus in on trading ranges and mean reversion strategies. So when it comes to designing your first profitable mean reversion strategy, let's look at where this fits into the trader evolution journey. And it's right at this initial stage of aspiring trader. And during this period of time, you're going to be thinking about how to develop, what concepts to use, and what characteristics of price action that you need to exploit. Now, many of you will know that I like to keep things really simple. My own strategies are all based on simple principles, and I know that as soon as I start to complicate things, the strategies start to perform less well. So I'm looking at a chart here of the S&P 500, but virtually any asset will show the same characteristics of price action that I'm going to talk through today. Now, with different types of trading strategy, they will only perform well in certain price action conditions. And if we look at this chart, we can see a whole range of these different conditions. Take a look at this price action here, where the price is increasing in this bullish rally rapidly. But look at the price action either side of it. It's completely different. Here, the price action is much more sideways, with up and down fluctuations along the way. So clearly, you're not going to find a single strategy that's going to work in these conditions where the price is virtually flat, and in these conditions when the price is rallying. So this is really the first step in terms of developing any successful strategy in my view. It's ascertaining what the market conditions are, what the price action characteristics are at this moment in time. And based on that information, it will tell you whether you can trade your strategy or whether you can't. And you need to wait for those conditions to change in order to start trading it again. Now, in my own terminology, I call this a filter. And the filter simply tells me if I can trade or if I can't. Now, over this and the next 2 episodes, I'm going to be looking at different strategies that work best in different market conditions. And what I'm going to do is focus on the principles that you should take in each of those when designing your own system. So I'm not going to give you a system to use, that's your job, but I'm going to take you through the process that I typically go through when I'm developing a system in this way. Now, in this particular episode, I'm going to focus on trading ranges and mean reversion concepts. So I'm going to focus between here and here. in the price action. So let's just expand this a little. So we've got the trading range in the middle of the chart here, and then either side we've got trending behavior. On the right, an extremely strong and volatile trend, and on the left, a less volatile. Now, if you're a discretionary trader, you can simply view a chart and make an assessment of what the price action is doing at the moment. Is it in a trend, or is it in a trading range? Or is it doing something else? But when you're an algo trader, like me, then you need a systematic and programmatic way of doing that, because you want your algorithm to automatically identify what's happening in the markets. Now, there are a whole range of ways in which you can do that. I'm going to show you an extremely simple one today, just to provide an example and to get you thinking about this for yourself in terms of what might work for you. And so to do this, I'm going to use two moving averages. I'm going to add a 20 period moving average and a 50 period moving average. Let's put this one in yellow. Now, take a look at the behavior of each of these moving averages. Firstly, on the right hand side, when there's a very strong trend, you'll see that the fast moving average is moving away from the slower moving average. And more importantly, it is not crossing that moving average. Look at the left hand side. We have the same sort of behavior here, if a little less extreme, but again, they are not crossing each other. However, look at the period of time while the price is in a trading range. Here, firstly, the two moving averages are much closer to each other, and secondly, they continually cross over each other. And this is a surefire sign that we are in a trading range. So, as I say, there might be better ways of doing this, but I just want to illustrate the concepts of the kind of things you have to think about and the kind of way that you will utilize indicators to tell your algorithm what is happening in the price action. Now, of course, the indicator that you choose should also be selected based on your coding expertise. So some indicators will be much easier to interpret in code than others. And so that's another consideration if you are an algo trader. And so what this has effectively done is provide us with that filter. It's telling us whether we are trending or in a trading range. And the whole concept when we are in a trading range is that we're looking for periods of time when the price is overbought, in which case we would want to mean revert and sell into that price action in the hope that it will come down. And when the price has fallen and become oversold in relation to recent prices, that's when we'd want to buy into the price action in the hope that the price would now go up. And as you can see, throughout the whole period of this trading range, the price is continually going up and down until the very end, when it eventually breaks out of the trading range into this trend. But it's these up and down movements as the price continually shifts from being oversold to overbought and vice versa that we might look to target. And to do this, oscillators are often a great tool to give us that information and to allow our algorithm to identify when we are in those overbought and oversold conditions. So a very simple oscillator that I like personally is the stochastic, and I like it because it ranges between 0 and 100 regardless of the time frame, regardless of the asset. So it's a normalized oscillator, if you like. So you don't want to use too short a period here. So for example, if you were looking at something like 5, 3 and 3, this just gives you too many signals, and every single minor movement is going to cause the oscillator to fluctuate from overbought to oversold. I tend to prefer a higher number of periods, which gives you the more substantial moves. So if I set this to 50, what we now see is that when the oscillator is in this overbought region, That's when the price is at the top of the range, and when the price is in the oversold region, that's when the price action is at the bottom of the range, and so on throughout the period of the trading range. So what we've done with these two indicators is firstly identify that the conditions are of a trading range, which makes mean reversion a good strategy to take advantage of the moves there. And then we've used an oscillator in order to tell us when the price is overbought and when it's oversold within that trading range. And from this, you could then go on and look at how you might develop your execution rules. Are you going to open a trade when the oscillator moves into this region? Or maybe moves out of the region, so the price move's already started? Or maybe you're going to be looking at inflection points like this at the top here. So there's a whole range of things you can now do in order to develop the actual rules of your strategy. However, the main point I'm trying to make here is that you're not starting off with indicators. You're starting off with price action. And that's what you should always do. Look for a particular type of price action characteristic that you're trying to exploit, and then, and only then, start to see which indicators will inform your algorithm about when that characteristic is in play, and also usually a second indicator to give you the signals. Now, one thing you'll find with this type of strategy is that you get a large number of trades. And that's good, because with a large number of trades, you have a statistically significant sample size, and you're much more able to believe the results you're getting from your backtesting process. If you're backtesting and you only have a few hundred trades, then the results could be down to pure chance as opposed to any statistically significant reason. Now, there's a really important point that I want to make here in reference to what we looked at in the previous episode, which was chasing price. And let's just compare the entry points of this strategy to what we talked about then. When chasing price, you're entering a position in the direction that the price is already traveling. And we looked last time at the reasons you shouldn't do that. However, look at what we're doing here with this mean reversion strategy. As the price is traveling up here and becomes overbought, at this point, we're actually entering a short trade. So in other words, we're entering in the opposite direction to that the price is currently traveling, and vice versa. When the price is coming down here at the bottom, this is the point that we're trying to target with a long trade. And so again, we're entering our position in the opposite direction to that of the price movement at that time. So hopefully you can see how this is exactly the opposite of what we looked at last time. And it's this contrarian view of entering trades in that opposite direction that all of my own strategies take, regardless of whether they are mean reversion, breakout, or trend following. And those latter two, of course, I'll be covering in the next couple of episodes. Now, in the next episode, I'm going to be looking at the characteristics of a breakout strategy. And this follows on really nicely from the trading range that we've just studied, because trading ranges do not go on forever. At some point, they end. And how do they end? With a breakout. And often, a breakout signifies the start of a new trend. So be sure to tune into that next episode. If it's already available, then you can see it top right now. But now until next time, trade safe.